Hello, everyone, and a very warm welcome to today's webinar hosted by UNCDF's FinWise team and Corps AgriFin's team. The webinar topic today is on alternative credit models, what's working for smallholder farmers in Africa. I can see we're still getting people joining. Probably let's give it a minute as people join, and then we will start exactly at 2:03 p.m. Great. We can start. Good morning, good afternoon, everyone, once again. A very warm welcome to today's webinar on alternative credit models, what's working for smallholder farmers in Africa. I'm Grace Njoroge, and I'm honored to be your moderator for this very important conversation. As we all know, access to formal credit remains one of the biggest barriers to agricultural growth and financial inclusion among and across emerging markets. And one of the things that inhibits it is the traditional credit scoring that often excludes those without formal banking histories. So today's discussion is going to focus on some of the alternative credit models and how this is going. And I'm thrilled, and we're thrilled to be joined by experts from different fields, including agri-tech firms, regulator, development organizations. And the goal of the discussion is to not only explore what's working, but also to surface the challenges and what we should focus on as a sector going forward. So just to start us off, we will start with a keynote from Mike McCaffrey, who is our East and Southern Africa Regional Digital Manager of UNCDF. In terms of the run of show, Mike will give us a keynote for 10 minutes, followed by a presentation of some of the models, successful models that we've seen in Africa, then followed by a panel. I will be introducing the rest of the speakers as the session starts. So welcome, Mike, to your session. For the audience, please feel free to put in your questions or comments using the chat box as the speakers present. We will have a question and answer session at the end of the webinar, but as the speakers present and you have an immediate question or comment, we invite you to share this in the chat box. So without further ado, I'd like to welcome Mike McCaffrey to give us his keynote presentation.
Thank you so much, Grace. It's wonderful to be here and to give this address. This is certainly one of the issues at UNCDF that we talk about most and that we hear about most from the different partners in the private sector we work with and the different policymakers that we work with, certainly around the East and Southern Africa regions. It's a big issue, right? If we look at just the East Africa region, depending on the numbers that you use, between 65 and 80% of people are employed in the agricultural sector, right? More like 65% directly, then 80% if you include the corresponding value chains. And I would say despite kind of 18 years of really robust, interesting, globally defining financial innovation that we've had specifically in East Africa, but now it's spread certainly to Southern and West Africa as well, with regards to payment systems and specifically mobile money. We've still seen very little movement in terms of the types of appropriate innovative financial solutions we'd like to see in the agricultural sector. They are not really yet still coming from mobile money or associated services like agent banking. They have very selectively reached rural areas. Not to say that those services are at fault. There are a number of issues that need to be addressed in tandem to go into rural areas that have to do with infrastructure, levels of literacy, market demand, that are very difficult to address all at once, right? And the services that we have kind of seen breakthrough, especially in countries here like Kenya, where I'm based, we still see large levels of dormancy in the payment systems. And we're not seeing them translate really into the overall things we want to see from a development perspective, be it kind of results like increased yields or incomes, and then the resulting kind of standards of living that we care about, right? From a financial perspective, if we look at it, the African Development Bank estimates this as a $75 billion issue on the continent in terms of the credit gap for farmers. And so we have to ask ourselves, with all this financial innovation, why do we still have such a large issue? Why are the financial service providers that we have more traditionally or have been created over this last kind of 2 decades of innovation still not offering the appropriate products that we need on the ground to really push the developmental needle? And I think when we segment them, it becomes fairly obvious. I mean, just to use some large kind of traditional segments, if we look at the banks, a lot of what we're talking about here, especially when we talk about the number of smallholder farmers, just not the target market, right? These transaction sizes are too small. They don't have the systems. They don't have the product suites. And that's not really what their kind of unique selling point is, right? It's more to corporates and governments, generally, at least in this region. Microfinance really requires population densities and infrastructure that are evident in South Asia and Latin America, but that we generally don't have in the different regions of Africa. There are some notable examples where we do, like Ethiopia. But generally, we see microfinance penetrations of 5%, maybe some places up to 10%, but not able to scale to the size of the issue as they might be able to do in more urbanized, high-density environments in other regions. And then uniquely, again, we have the PSPs that have done amazing innovation and development over the last couple decades and have started really moving beyond payments and looking at credit. But most of what is happening still is consumer credit, right? Which is a different ticket size. It's a different data set that's being analyzed. And most importantly, from UNCDF's perspective, different impact, right? Really what we're talking about here in terms of data-driven finance for smallholder farmers is productive credit, productive finance, financing cash flows and businesses that can grow, not necessarily the things that a consumer would buy if they're able to access a little extra money. And so when you set the problem like that up, it's almost understandable, even though a lot of the technology and business models do exist out there in the world. Especially in other regions, we've seen a large proliferation of what we're calling data-driven finance, or what other people call algorithmic finance, over the last decade. And, PayPal just released their financials, noting that they've just surpassed $30 billion in data-driven finance to MSMEs, right? We look at other tech fins or fintechs out there in different regions, like Alipay, like Tencent, like Block. They're doing similar things. And the reasons why they've been able to scale in ways that we haven't here in the region, and specifically with the farmer segments that we're talking with, are also understandable, right? If you look at the data that they're using to scale, well, it's almost always, even beyond the example companies that I gave, payments data or e-commerce data, right? And payments data from businesses, not consumers. Those data sets we just generally don't have. If you look at LDCs across Africa or even the more developed countries like Kenya, e-commerce penetration rates are sub 10%, right? They're just not being used to the degree that they are in Latin America, Asia, Europe. We have still seen some deployments into that space. I think Pezesha here in Kenya, Wasoko, who's operating across the region as well. A lot of the developments that came out of pay-as-you-go solar in the 2.0, once data started coming in from those payments being used for other types of asset financing are examples of that. And so, what I want to talk about is kind of the things that we will need in this space moving forward to really bring some of this global success, not only to the region at more scale, but specifically into rural environments and specifically to work better for farmers. And if we're able to do that, or hopefully when we're able to do that, I do think it will be another groundbreaking moment that probably this region brings forward to the global environment, because it's not being done well in many places, and certainly not with the types of constraints that we have. The first constraint that we really have is data. To do data-driven finance, you really need data. And there's a dearth of it generally, and most specifically in rural areas to do with agriculture. We need granular data on yields, on weather patterns, on the soil, and digital IDs to be able to roll out these systems seamlessly at scale. Right now, what we see are two emerging models, the first of which we'll talk about in the second webinar, which we hope you guys will attend, on digital public infrastructure and how that can be used to build some of the foundational databases that will lower the cost of business for some of these private sector providers that are looking at these models. And the other is business data, right? And we've seen data sets being built by companies that are here today, like Imata, others that we work with around the region, like Insabuco, other countries here, companies here in Kenya, like Sun Culture, that are able to digitalize some of the data on their customers that they can use to then on-lend, or digitalize some of the data in the ecosystem that give them a competitive advantage and allow them to use that data essentially as collateral and risk score potential borrowers, right? The second is business models. And I think that's the right term to use, although it's often misinterpreted as, the existing financial service providers need to implement new business models. That is true in the case that it is in alignment with their unique selling points, with their DNA, with their goals and KPIs as an organization. In this region, that's generally not true. And really what we need beyond business models are a new cadre of financial service providers that are fit for purpose to develop and own and scale these business models. And we've been really, really encouraged to see the emergence of different fintech organizations, different agtech organizations that are being built to meet these challenges. The challenge is not for the faint of heart. Really what institutions need to do, or organizations need to do to succeed in this space, is not just be a fintech player, but be an ag tech player. Or they need to have expertise in ag and tech and in finance all at once, right? Starting up and entering into one of the hardest markets to address we have here in the region. Second is they need to be digital to really lower the cost of deployment of the services, the unit cost or cost per customer served, right? But they need to do it with a high touch, because we have low levels of digital and financial literacy, because we have low levels of trust with small new organizations that go and try to offer these services, right? They need to really build in transactional efficiency, but they are set with high upfront costs, especially with regards to the first constraint on how do you collect all this data cost effectively, right? And then the third, which we'll talk about more in the last webinar in this series, is capital. And that's capital that organizations like AgriFin, like UNCDF are deploying specifically in very high-risk innovation areas and in the form of grants. And where UNCDF specifically would like to use some more of its sophisticated tools in terms of loans and guarantees to support the development along the full trajectory of the ecosystem, right? As growth incurs and risk is lowered, how do we usher some of these institutions to scale by reducing the levels of concessionality that we give them until they're able to access commercial finance without us. Today, we have a fantastic group of experts. I'm very happy to see Grace moderating today. She always does a fantastic job, and we are very grateful for this partnership with AgriFin because of our shared objectives, and specifically because of the expertise they have in agriculture, which really complements some of the expertise we have more in finance. I look forward to learning a lot and to an engaged discussion. Thank you very much.
Thank you. Thank you very much, Mike, for that very exciting introduction to the session. Thank you for laying the challenges that are before us, for highlighting the opportunities. And without further ado, I will now hand it over to two of the companies that are using these data-driven models in Africa to share their journey, to share some of the lessons and insights that they have found along the way. And to start us off, I will introduce Abraham Andreas, who is the founder and managing director of Lasha in Ethiopia, to share with us the Lasha journey with data-driven models. Welcome, Abraham.
Good afternoon, everyone. I hope you can hear me. Good to hear from Mike. My name is Abraham Andreas. I'm a managing director of Lasha. Lasha is an AgTech company based in Ethiopia and currently trying to expand to Eastern and Southern African countries. Leveraging our experience of over a decade, we are trying to provide a tailored financial service for smallholder farmers in Africa. I second most of the comments shared by Mike in terms of how smallholder farmers in the wider African context are excluded from financial services, and data is always brought up as a reason why these smallholder farmers are not accessing financial services. To give you a little bit of context, Ethiopia is one of the populous country in Africa, with more than 85% of the people directly engaged in agriculture. And in the last couple of years, the National Bank is requesting more than 32 licensed banks at least to allocate 5% of their agriculture portfolio to go to agriculture. But in reality, farmers are accessing less than 2% of the bank's entire agriculture portfolio. And in the majority of the challenge related to one is the data scarcity. These farmers are not joining in agriculture just now or last year. They have been in this sector for the last many decades. But their credit history and financial transaction is not properly captured. In many cases, it's not digital. And the financial institution, especially with the traditional system, they don't have the experience taking credit, also conducting a financial transaction with these banks. The other is also agriculture is seasonal, and most of the smallholder farmers are looking for a small ticket loan between $250 to $400 to procure the basic farm inputs. Yes, we always hear agriculture is risky, but also agriculture feeds the nation, and some of the risks can be managed through agricultural insurance, can be managed through different risk mitigation mechanisms, especially by leveraging the climate advisory service. But most importantly, the financial institutions are collateral dependent. In Ethiopia, collateral is still the premium requirement for borrowers to access credit services. So these are some of the primary challenge, pushing back farmers from accessing agricultural financial services in agriculture. And Lersha, as a digital platform, we call ourselves running a phygital model. We leverage digitally enabled use in a rural area. For the lack of better term, we call them Lersha agent. These are son and daughter of a farmer in a rural area. They already have a trust with the community. And Mike was earlier mentioning about the cost of data collection. Leveraging these agents, we have a competitive advantage to collect data, and this data can be used as a bridge to assess the creditworthiness of a farmer. With the consideration that transaction and credit histories are not available, most of the collected data are farm and behavioral data. And these at least assess the creditworthiness of the farmer, triangulated by agents' information, as well as triangulation with some of the microfinance, as well as the farmer union and primary cooperative, where the majority of the farmers are a member. But these farmers are mainly run a fragmented land, and they are excluded from financial services. And by providing only financial service, we don't believe they will be productive and their income will increase, because they still need the agricultural services. And the purpose of these credit services are to get the agricultural services. So we run a bundled model for any value chain whenever we approach a farmer through our agent network, where these agents use a digital tool developed in-house, multilinguistic, and also offline, assisted by an offline call center located in different parts of the country. They provide multiple services, and these use model create job, as well as it consider connectivity, literacy, and the phone ownership of the smallholder farmer in a rural area. And these solution, as you know, we are not just another fintech company. Rather, we provide our value proposition to the financial institution is we don't only help farmer to access financial service, but also bundled with the agricultural services. So usually when we discuss with the banks, it takes over 6 to 12 months time to align with the way how financial institutions operate. And once they understand how farmers behave for different value chains, their existing credit model should be enhanced. So we use our agent network. We collect over 137 points from a single farmer, categorized under agronomy, demography, psychometry, gender, and climate data points. And these data points are used to assess the creditworthiness of a farmer, where for each value chain, these data points and the threshold might be different. But most importantly, the business model. We built this model in a way where we promise high productivity and better market for the farmer, and low default rate, as well as new customer basement for the financial institution, and also a good quality to an off-taker, where in this model, anchor firms or off-taker play a big role by managing the risk, as well as guaranteeing a better price to smallholder farmer. And some of the data points are collected in a survey, but with the repetitive nature of accessing financial services from this financial institution, the farmer credit behavior built over time. I think some of the success from the last couple of years attempt is one is tailoring this scoring model for different geography, different value chain, and farmer type. As you know, farmers in the livestock, farmers in cereal crops, in the oil seed and in coffee or vegetable, they behave differently. Some value chains are women friendly. Some value chains require a higher finance. So accordingly, we tailored the scoring model, and we also consider the climate information. These climate information we have seen in the last couple of years, where the minimum repayment rate was 97%, and in some of our pilots and in value chain efforts, 100% repayment from these smallholder farmers. And with embedded service, the majority of the smallholder, almost all smallholder farmers, they don't receive cash, rather they receive input from the agro dealer, where during the repayment, they also submit their output, quality output to the off-taker. And the off-taker repay the loan the bank, and the remaining amount will be sent to the smallholder farmer. There was a flexibility to do different threshold for different financial institution according to their appetite to agricultural risk. And also there was a flexibility to do API to their loan management system. Currently, we work with 6 different commercial banks and 2 mobile network operator, where we take a responsibility to manage the data, where we maintain farmers' data according to the country law. Now we are focusing on the input financing, where farmers are onboarded and provided with small ticket loans of $350 to $450 according to depending on a different value chain. But what comes next is also to strengthen and stabilize their warehouse as well as aggregation effort, and also for some of well-performing farmers to access asset and mechanization, but also to transform them to a more of a full financial access from smallholder farmers. And moving forward, scalability of such data-driven models, the anchor firms play a big role, because of market failure, the entire model could collapse, and such anchor firms with a bigger responsibility, they can do a lot. And actually, they can. Some of our partner anchor firms used to source a maximum of 10% from smallholder farmer, and currently they are accessing more than 40% directly from the smallholder farmer, and they are getting good quality, and they want to do more. But also the financial institution interoperability. Financial institutions should be a bit flexible to link their loan management system to such AgTech companies, where they can get new farmer on the ground, and they can expand their portfolio. These models are expansion ready, but this expansion also should consider multiple value chain. Currently, we have 6 different value chains, including maize, wheat, malt barley, soybean, vegetable, livestock, and coffee. And currently, we are working more with the smallholder farmer, and down the line, the commercial farmers are also interested to do in a contract farming. Recently, we have tested the MNO partnership. MNOs, they have a huge data on transaction of airtime and data, and this is very helpful to improve the credit scoring and also to improve the bundle service. Development partners and DFIs such as UNCDF and AgriFin, they can play a big role in terms of improving the infrastructure. Could be the DPI infrastructures like the national ID. Also providing first loss guarantee, especially on new geographies, and to handhold financial institutions to test the model. National-wise, I think in 1 hour time, Ethiopia will launch the National Agriculture Financial Roadmap that recognized the use of alternative data. And I think such steps are very important. But also the climate shocks, such a model also should consider backing up mechanism for climate shocks, and I think such partners can do a lot. Thank you so much for the opportunity, and looking forward to receive questions, if any, from the audience. Over to you, Grace. Thank you so much.
Thank you. Thank you very much, Abraham, for that very insightful presentation, all the way from the problem to the solution to some of the gaps that still remain. We appreciate the depth you've brought to this conversation, and I'm sure there will be some questions for you at the end. With that, let's now hear from our next speaker, who is Bram. Bram van den Bosch is the CEO and co-founder of Emata in Uganda, and he'll be sharing his experience from the Uganda context, and also sharing his model with us. Over to you, Bram.
Thank you, and thanks, Mike, and of course my namesake Abraham, for setting the scene. Abraham, we're in the same game, so much respect for the work that you're doing. Here at Emata, we dare farmers to dream big. There's a group of farmers that if you give them a loan, it's almost like magic is happening. Their productivity and their income is increasing very, very rapidly, almost 3x in a year. Admittedly, this is a small group of farmers. According to our estimates, about 10% of these farmers behave this way. There's about 10% of these farmers who are really, really good farmers. People just never realized how good of a farmers they are because they never got the capital to grow and to show what they can do if people support them. And at least for me personally, that's, and maybe this is a controversial statement, that's what capitalism was originally supposed to do. And in our case, that's what we feel we're doing with Emata, where we drive the scaling and professionalization of agriculture in East Africa from the bottom up. Now that's the why. Let me talk a little bit more about the how. So how we do this is by combining technology with partnerships. And with partnerships, we mean off-takers and cooperatives. So we work with some of the largest coffee exporters in the world, some of the best dairy factories in the region, and a lot of agricultural cooperatives. And it's this combination of technology and partnerships that's really key. So the technology makes things efficient, right? Makes it a good experience for a farmer. Make sure they don't have to travel very long distances, and make the lending the loans instant, which is ever more important given climate change, so that the seasons are becoming less predictable as a result. And these partnerships that we have with the agricultural companies and cooperatives essentially make the model work. It allows us to tap into an existing ecosystem as opposed to recreating yet another ecosystem, which we've seen in other industries just doesn't work. If you look at the solar grid industry, right, at some point you had 5-10 solar companies all targeting the same areas. Yeah, the unit economics just don't work. And we tap into the existing ecosystem of these cooperatives, of these off-takers. And that allows us to provide loans that, as Mike rightfully pointed out, are productive as opposed to consumer loans or predatory loans, which ultimately comes down to the interest rate. And of course, right, the real difference between a consumer loan and a productive loan is simply the interest rate. And this model where we combine technology with partnerships allows for scale, allows for the clever use of data, which indeed is key, and the flowing of repayments through tying in off-takers. Now, those are all very big words, so let me make this a little bit more concrete. In our company, there are 4 steps that we do. So the first step is we digitize. So we make sure that the farmer buying that these cooperatives and these off-takers are doing becomes digital. And that gives us, in turn, access to an automated, validated stream of data. And indeed, data is key. And that's the second step where we do the credit scoring. I say credit scoring, but actually 70% of what we do is cleaning. Sometimes we call ourselves a laundromat, where I would say 70% of the time, indeed, we're just cleaning up the data to make sure we get good data sets. And then the rest of the time, we actually produce forecasts, how much these farmers are going to deliver, and return those forecasts into credit limits, because ultimately that's what we're after. We want to loan to these farmers. That's the third step. We lend to these farmers, and where need be, we add insurance, crop insurance on top of this loan product. We run a model in which our partners, so the cooperatives and the off-takers, essentially act as our agents, where we provide them support, we provide them technology, and we do all the financial insurance and digital literacy training. That's very necessary. And then last but not least, there's the fourth step in our model, and that's where we do the repayments. So the moment the farmer asks for a loan, we lock in what we call a minimum quantity of produce that the farmers need to deliver to our partners. And that's how we get repaid. And even those payments from the partner to the farmers, we have meanwhile digitized so that we run a full ecosystem of products where we digitize, we credit score, we give out loans, we do the insurance, and we handle the payments if need be. And that system, is working quite well. So if we look at our results, we are indeed here in Uganda. That's our base, where we have worked with over 90 agricultural partners and cooperatives. We are currently tracking 52,000 farmers that we credit score periodically. This year we'll do about $1.5 million worth of loans to farmers, and we expect this will be 3 times as much next year. We're growing quite fast. We're specialized in seasonal loans, so the average tenor of the loan that we give out is 4.5 months. We feel that seasonal loans are by far the best product to give to these farmers. Yeah, anything too short, of course, is useless because farmers think seasonal, but anything too long requires often too much financial discipline and is not good for repayments. Average loan size is very interesting. Our average loan size rate starts as small as $15 and goes all the way up to about $8,000 with an average of about $350, which is interesting because that's exactly, of course, what Abraham at Lersha also said. Our sweet spot, so this magical segment of farmers that I alluded to earlier, these 10% of farmers that we really prefer to work with, they typically start to borrow anywhere between $300 and $500 from us, and then they move upwards into the thousands of dollars. But that's our sweet spot. Repayment rate has been really good, above 95%. We worked across 12 value chains, and I need to be honest, not all value chains gave us the as good results as others. And at least for our company, our best results we have in dairy and coffee. Hence, we sometimes jokingly call ourselves a cappuccino company. In terms of impact, the numbers are very interesting. What we see at farmer level in terms of productivity and income increases is 30% on a seasonal basis that farmers move up. Now, again, this is an average, and the best group of farmers with whom we work, we see them doubling and tripling. But at the same time, we definitely see less exciting results when we look at the very, very smallest farmers whom we lend $15, $20, $25 there. We almost see no productivity effects. And even the largest farmers, we're not too thrilled about the effects there. And that's interesting because I know there are a lot of people out there who really want to give loans and support really small farmers. And so are we. We still give them loans. But at least in our data, what we see is that we don't see a very big productive effects in that segment. Now, what's also interesting is that if we look at the partner level, what's happening there, we actually see deliveries to our partners increase by 80%, which is really an interesting number. And this 80% is composed of the productivity increase that I alluded to earlier of about 30%. But then the biggest part, about 40%, comes from a reduction in side selling. So farmers actually become much more loyal to the cooperatives and the partners that we work with, and essentially become less loyal or go less to these informal traders or loan sharks. And of course, the partners attract more farmers as a result of the fact that they're now a more attractive institution for farmers. So the 80% is quite an important number, not just because it's big, but also because this is really important in terms of strengthening formal agricultural value chains, because that allows for better value addition, higher food safety, more valuable exports for our country, etc., etc. Now, this stuff is indeed incredibly hard, and for many years we have made tons of mistakes and a lot of improvements, and we went through really, really tough moments. But we do believe it's possible. As I mentioned before, for us, the combination of technology and partnerships is super critical. Why? Because essentially agriculture is an environment that is very tech unfriendly, right? Reception is terrible. Farmers have no smartphones. And even if they do, they don't use them in the same way as people in the big cities tend to do. And for us, the partners really play a key role in terms of solving those last mile issues for us, where tech in theory can work, but in practice it will break. And yeah, for us, that model works because, yeah, in return, these partners get an 80% increase in volume, which of course is a very attractive value proposition. Yeah, and then combined with the fact that we as a company, don't do anything else but agriculture and have specialized our entire technology and data science set to it, as opposed to trying to do this across many industries. Yeah, at least for us, is I think the reason why we're getting the results that we're getting. And indeed, as much as this is still early days, yeah, absolutely, digital models can deliver very good results. Looking ahead, so we launched here in Uganda in 2021. We have now started the rollout across East Africa. Tanzania will come first. We hope to launch Tanzania end of this year or otherwise early next year. We are also looking at Ethiopia, and I will actually be there next week. So if anybody wants to talk to us about what we do exactly, please let me know. Yeah, what we're also going to do, just like Lursha, is we're now setting up bank partnerships. So here in Uganda, we have our own license, we have our own MFI license, because we felt that was the best path to do all the learnings, that we can just go on our own as opposed to going back to the bank every time for approval in case we change anything. So for us now, working with banks is definitely a new and exciting era in the future of our company. Let me just wrap this up. So as I mentioned, we dare farmers to dream big, and for us, the mission is to professionalize farming and back the best farmers that are out there, season after season, with affordable loans. Definitely, we are big believers that technology can deliver value, but it's not easy, and it may take slightly longer also than we thought. But so far, at least, we have not encountered an issue that we can't solve. When we started this company, we once said that we were going to finance 100 million farmers. That may take a little while still, but we are still convinced that we will reach $100 million worth of loan volume to farmers in the next 5 years. And hopefully with the partnerships or the support with some of you on this call, we're able to achieve this slightly earlier. Thank you.
Fantastic. Thank you very much, Bram, for this valuable insights. Thank you for sharing about the journey of Emata, your model, the growth so far, as well as your journey ahead. Thank you. It was a coincidence. We had two Abrahams doing the presentations, which is,
that's not a
really
coincidence.
Nice coincidence, because Abraham is they're considered the father of nations. So in this context, you can also be considered the fathers of data-driven lending, just based on the work you've done so far. So thank you once again to both of you for your presentations and for sharing with us those very useful insights. I will now invite the panelists for the panel discussion. Again, for the audience, please feel free to put in the chat, and thank you for the questions that are already coming in. We have a Q&A session at the end, so any questions for Bram, any comments on Emata's model or questions, please post on the chat, and Bram will be able to respond to them at the end of the webinar. To take us to the next session, I want to introduce Oscar Otieno. Oscar Otieno is the Deputy Data Commissioner, Office of the Data Protection Commissioner in Kenya. I also want to introduce Edwin Urassa, who is the CEO and Executive Director of Credit Info Tanzania, as well as Matthew Strickland. Matthew is the Market Engagement Director of GSMA's AgriTech program. And last but not least, we'll also have Betty Mureithi in the discussion. Betty is the Senior Regional Digital Financial Services Manager from Corps AgriFin. And without further ado, I want to shoot the first question to Oscar. Having had all the useful and very insightful discussions that we've just had from the three speakers who've gone ahead, there's a lot about sharing of data, partnerships where data is shared between different organizations. Oscar, from a regulatory perspective, what are the legal and regulatory frameworks that govern the collection and processing of smallholder farmers' personal data for these purposes that we're discussing in this webinar of credit scoring, and what are some of the risks that are posed and how are these managed? Welcome to the discussion, Oscar.
Yeah, thank you, Grace, and thank you for having me. It's really a good question, and as you said, we've seen in the last 3 presentations that has come before this, there is a lot of collection and processing of smallholder farmers' data, collecting, processing, and sharing of the same for various purposes, maybe for credit scoring, for risk management, or even for financial services, like probably onward digital lending and all that, which is really a very good thing. And again, from what we've heard from those players, there is a lot of players in this sector, which include the financial institutions. We've heard of the AgriFins, we've heard of the fintechs, we've heard of the both state and non-state actors, which is a very good thing. And what we are really saying from a legal and regulatory perspective is that in any given industry, it has been shown and proved that maybe 95% would be doing the good thing, the right thing, giving out products and services for the benefit of the majority. But there is a few players who may also want to go around the various laws and regulations, if at all that sector is not regulated, for purposes of just benefiting themselves at the expense of the few that are there, at the expense of the few beneficiaries. Like, for example, we know here in Kenya that a single data set of a farmer, if it gets to the wrong hands of our brothers and sisters who are within the correctional services, it can really cause a lot of harm. So then there is need of protecting these data that these various players is collecting and processing. And first and foremost, we want to start by the frameworks that are existing there. Number one, informed. Yeah, we are talking about these players informing the various data subjects the reasons why they are collecting this data. If you think and feel that you are not satisfied with the reasons being given to you why this data is being collected, then it is within the right of a data subject, in this case a smallholder farmer, to reject to giving you that data for purposes of processing. Then now with these new laws of data protection and data privacy, there are obligations that are being passed over to these actors that we just mentioned. For example, we must put in place the lawful basis under which we are collecting this data. And there are various lawful bases. First and foremost, you might want to rely on consent, which must be expressly given. You may rely or you may develop contracts, so you get into contractual obligations and all that. And within all these laws, there are various principles and rights to the data subjects, obligations to data controllers and data processors, things like data minimization. Just collect what is enough for you to offer your product. Don't go collecting so much of a smallholders, farmers' information. And then for what purpose are you collecting that data? You must abide by, now the law requires that you abide by that purpose. Don't collect for purposes of maybe onward lending. Then again, you get your friend who is doing subsidies. You want to share this data with them. There are obligations such as the security and confidentiality. No farmer would wish to walk into probably any county offices and find his data lying around, data that he had already shared with one of the actors. Transparency. If I came out and asked you, how are you processing my data? Are you willing to freely show me how this is being processed? Are you accountable to it? Are you using this data for profiling? For profiling me? Those are the things that we should look out for. And maybe last but not least, from where I'm seated, I've not seen a case, but it is there within the law that you may not subject somebody to automated decision making. So if you are using this a model for purposes of credit scoring, and I don't want to be automated to that, I may want to request you to do for me a manual credit scoring. But I've not seen that. We are moving forward, but you never know where we will be going to. So those are some of the legal and regulatory frameworks around these data that we are collecting for farmers. And I hope if we had more time, we put it into more good context. Thank you, and back to you.
Thank you. Thank you very much, Oscar. That is very insightful for everyone to take into consideration, even as we are talking about innovation and very innovative models that we are creating. We also need to be cognizant of operating within the set regulatory frameworks and taking into consideration some of the perspectives that Oscar has shared. Thanks again. I will move to Edwin Urasa from Credit Info Tanzania. And Edwin, I know at Credit Info, you are doing a lot with alternative data. So I just want to invite you to share around some of the data that you are using to predict scoring models, especially for thin file and banked clients, such as the smallholder farmers. So I know we've had a bit from Emata and from Lasha, but from Credit Info Tanzania, and also being cognizant that there are different contexts with geography, cultural considerations, etc. At Credit Info, what are some of the alternative data sets that you have seen that have proven most predictive in your scoring models?
Yeah, thank you, Grace. Good afternoon, everyone. Yeah, so for Credit Info, there are a couple of models that we have actually developed in the last 3 or 5 years, I'll say. I'll start with microloans for the MNOs. We went into partnership with Vodacom together with a local bank here, DTB. It's a regional bank, actually. And we developed a microloan facility back in 2022. That was when we started for Tanzania specifically. And during that time, we also extended a similar proposition to another MNO. In a country, but I'll be more specific on Vodacom. Yeah, there was a Vodacom. Yeah, sorry for the name. There was a Vodacom and as
Edwin, your line is cutting. We're not able to hear you very clearly. Edwin, maybe you could check your connection.
Fintech that was participating this ecosystem. We started the individual. Sorry, yes, Grace. Can you hear me, Grace?
Yeah, maybe you can just put your video off to see whether it's going to be a bit better. Thanks.
Okay, yeah, can you hear me?
Yeah.
Right?
Yes, much better now. Thank you.
Yeah, so as of now, we have about 500,000, I would say, in terms of individual consumers that are currently accessing the product itself. And is currently in partnership with the same bank, DTB, together with a fintech. And the success story of that, again, is coming from the alternative data point that were made readily available by the MNO. So here I'm speaking of the transactional data and the GSM data, which enables us to actually develop the first mobile scorecard in Tanzania under Credit Info. We've done it in Kenya with other partners as well. But what I would like to highlight in terms of the key enabler was the transactional data coming from the MNO in terms of the inflow, outflows within the wallet of a consumer, as well as using the GSM data, such as number of texts, how long the SIM card has been active, and other variables. So that has been quite very successful. Then we embarked on a different initiative targeting the smallholder farmers that are currently located in Kilombero Valley. These are sugarcane farmers, and The model itself is again based on alternative data, but here we had the chance to partner with another off-taker that is currently operating there, which happened to be the Kilombero Sugar Factory, together with a Tanzania Sugar Board, as well as the AMCOS. AMCOS is a cooperative union that are an umbrella for the farmers. And within this particular initiative, there were about over 10,000, I'll say, registered farmers. And again, the key enabler of success is the existence of the off-taker, whereby we were able again to get the transactional data, meaning that to ascertain the ability when it comes to income, which are coming directly from the proceed of the sugarcane that have been sold out to the Kilombero factory. Subsequent to that as well, we have managed as well to obtain transactional data from the lenders, balance sheet providers as well, together with another data point that were coming from the Tanzania Sugar Board, which again is like a register for farmers in terms of for all sugar farmers that in Tanzania that are currently being registered within this particular registry. So that again enables us again to build up a model, a credit scoring model from 2023. And luckily enough, we were supposed actually to launch it last year, but fortunately due to some unforeseeable event that had happened, we've managed actually to launch it just last week, together with the two balance sheet providers. So that has been just a journey in terms of how Credit Info Tanzania has evolved herself in terms of using alternative data specifically for two initiatives that I've just pointed out. But over and above that, I mean, we are currently having quite a number of alternative data sets within our portfolio or within our data set, such as coming from the Tanzania Revenue Authorities and Education Student Loan Board. But those are the two key examples that I could give based on a project that have actually materialized to a point whereby we've been able to deliver a particular scorecard, and that scorecard is actually being used, or it has started being used by a number of balance sheet provider in the country.
Fantastic. Thank you so much, Edwin, for sharing what Credit Info is doing in Tanzania with some of the partnerships and the approach. And we wish you the best of luck as you continue to implement that program. I want to move over to Matthew Strickland from GSMA's AgriTech program. So Matthew, from your perspective as GSMA and from the AgriTech program, and also being cognizant of the fact that you've supported a lot of innovators within the space, what are some of the lessons that have emerged, such as from the recent program that you are working on in Papua New Guinea, and what could be scaled across other regions? As you're answering that, maybe you can also, from a portfolio perspective and from your perspective as an ecosystem player, what are some of the gaps that you see that still remain? And also, as you're answering, also from your vantage position, having supported multiple organizations across regions, Africa and Asia, do you see any cultural or regulatory differences that impact the adoption of models across different geographies? Welcome, Matt.
Thanks, Grace. Hello, everyone. It's quite a lot to get through in a few minutes, so I'll scoot over it. But if anyone wants to follow up, then feel free. So I was trying to think of something that we wouldn't have heard about already. So which is why I wanted to talk about the project in Papua New Guinea, because there is loads of transferable learnings and ecosystem that is applicable to sub-Saharan Africa. So I wanted to try and parallel a few of the things that we've heard already. So Mike was talking about business models, the high upfront costs, and the cost of acquisition of customers. So the project we were working on was with vanilla farmers, and there was a tripartite partnership between an AgriTech, so a tech firm, a vanilla off-taker, and a local bank. And the business model that was put in place was a revenue share that occurred between the bank and the agribusiness. So the agribusiness weren't really making any money out of this, but this was covering some of their extra costs in terms of the farmer outreach and helping with the digital financial literacy training. So essentially, what a specific rural loan was created based on some fairly or relatively basic criteria that the farmers needed to meet. So we have very similar situation in terms of lack of bricks and mortar banks close to the farmers. Infrastructure is pretty poor in the more rural places. Low financial digital literacy, low financial literacy. So very similar problems that we've talked about and heard about already this morning. So what we were able to do was create a scorecard based on, as I say, these relatively basic criteria, and applied what I've heard before as a lend to learn model. So we knew there was going to be a degree of default on some of these loans, or certainly delayed payment on these loans, but we were aware of that, and we expected it, and wanted it is the wrong word, but it would help train the model. So it was very intentional to have that. We didn't obviously want to put people into big trouble, so there were a variety of loans that were offered, ranging from between roughly $80 to about $300, depending on how many vanilla vines these farmers had and their history selling to the company. So the kind of kicker with this particular project was that we were able to backstop, or through another partner, were able to backstop the bank. So their risk of issuing the loans was significantly reduced. So they still had cost of issuing, creating bank cards, creating bank accounts and managing those accounts. There was a lot of cost that went into creating the digital tool that was used to digitize farmers, digitize procurement. But in terms of the risk with the loan portfolio, the project was able to backstop that, to kind of kickstart the project, get the loans out there, and start learning from the behaviors of the repayment system. So yeah, it's difficult to go into too much detail at this stage, but I also wanted to highlight the project we're currently working on through GIZ, this AgriTech Accelerator, or the GSMA AgriTech Accelerator, where we're working with several organizations across Africa. One of the models that's being introduced is in Nigeria, with a company that are digitizing the supply chain, and they're actually issuing loans based on the value of the crop that's being collected from farmers. So again, using a digital tool in partnership with the bank to issue to help create bank accounts, but basically providing loans on against the value of the crop that's being collected, not 100% of the crop that's being collected, but based on the value of that crop, they're able to issue a loan against a percentage of that at an interest rate that is quote marks affordable to a farmer. So it's certainly not in the 20-30% that we often see, below kind of 6%, so a bit more affordable given the other loan options out there. There's also another company that we're working with. So they're not issuing loans themselves directly, but they are enabling the transfer of data between various partners and players to link co-ops, agribusinesses with financial service providers and MFIs. So they're kind of creating the rails on which this data flows to make it far easier and less costly for the banks to understand the customer and issue the loan. Okay, so I think the second part of your question, Grace, was kind of learnings and issues and gaps. Obviously, with the project in PNG, there was two of the key criteria were that the farmers already sold to the business, or had already sold to the business in the past, and had a certain number of vanilla vines. So this obviously eliminated or excluded, I should say, farmers who simply just had fewer or a smaller farm, essentially. So we weren't reaching the really small, really low farmer. We also noticed that very, very few women were picking up the loan in this particular context. One of the other elements of this loan was that there was a very small application fee to kind of get buy-in from the farmer, that they'd obviously invested in this loan a little bit, and therefore they were committed to the loan. in order to try and help drive more women picking up this loan, we actually removed the project removed the application fee, but this didn't really have a huge impact on new women coming into the system or into the process. So culturally, you know, it depends on context, but whether the agent force, you know, the gender mix of the agent force is really important. People feel more comfortable talking to someone of their own gender often. It depends on who is making decisions in the household, who's got access to a phone. There's a whole piece and lot.
Matt, I think you've accidentally put it on mute. Put yourself on mute.
Sorry, Grace. Thank you. I don't know where you lost me, but I was talking about access depending on kind of the agent mix, infrastructure coverage, and what was the other point I was making? Just, yeah, it's sort of decision making within the household. These are all elements that are transferable across many, many cultures. Did I answer all of your questions, Grace? I'm sorry.
Yes. Thank you. Thank you. Fantastic insights. Thank you very much, Matt, for sharing what you've seen from the projects and especially from the PNG program that you're implementing, and quite some food for thought there around some of the insights that you've shared. I now want to turn over to Betty Murithi. And Betty, from your perspective, we all know that on this call that the traditional lending, some of the reasons why this was not flowing to segments such as the smallholder segment is lack of collateral. So how are lenders managing risks and ensuring repayment when they move away from collateral-backed models?
Thank you, Grace, and good afternoon, everyone. I think this discussion has been very interesting, and coming to this question, yeah, I know a lot of feedback has been, and I think even from the beginning that there's a risk averseness to lending this segment, of course, by the larger institutions, but it is well understood because of the nature of credit assessment and also collateral requirements. And this is where this discussion becomes important in terms of looking at the fintech space, the AgTech space, and what is coming through in terms of how much information we can now get about the farmers that we are working with. Over the course of the years in the AgriFin program, we've worked with over 150 partners, and one of the things that we're starting to see now is a good appetite to actually start getting a 360 view of the farmer activity in terms of whatever digital footprint exists and whatever can be built on in terms of their transaction histories, the activities around their farming work. So that would include input purchase, and all other activities that are related to the crop cycle, and how then can we leverage this information. So we're starting to see, AgTechs and fintechs starting to now sort of gather this data, aggregate the data. It could be through a cooperative, or other functions within the ecosystem in which the farmers are working. Another way that is actually developing quite well now is group lending and social collateral in terms where farmer groups have also been able to show that they're able to put some pressure around each other, have some peer monitoring where they can get quicker access to loans by virtue of being in groups. And this actually has extends even to savings groups for women, for example, where we are starting to see activity around them coming together, approaching structured financial institutions or the AgTech fintechs within the cooperatives they work in and accessing loans. Of course, value chain financing is a key one, where, of course, any integration or formalization of value chains produces better outcomes with lending, where the crop cycle is understood, potential yields are also understood season by season, and so providing some access again within smallholder farmers who are within structured value chains. Again, the importance of cooperatives, the importance of understanding how aggregators and maybe larger buyers work with the smallholder farmers in order to build that digital footprint for the farmers. We've also seen, of course, insurance becoming a key part to resolving some of these, I would say gaps that we have had in terms of managing risks. So where insurance has been, accepted, particularly parametric insurance products that are not too expensive for a smallholder farmer to acquire, would also help mitigate risk for the lenders and therefore improve the risk profile for the smallholder farmers. Lastly, of course, is the capacity building technical support. I think that the development sector continues to really engage in to just support knowledge, awareness of what financial products, solutions, particularly to do with credit, are available to farmers. How can they access them? What do they need to do to maintain a good credit history? So at the end of the day, we start to see now data coming around, in a way that a fintech can start to take small risks. As we say, we graduate these loans from small amounts as we get to understand the smallholder farmer, and which is why I think the discussion today is quite important, because just bringing in all our knowledge as we integrate technologies, as we bundle solutions, also just bringing together the knowledge that we have built in the sector over the years, and maybe come up with, product design that could be customized for the farmers that we are serving. Thank you, Grace.
Thank you. Thank you very much, Betty, for those comments that you've shared there. I see we only have 2 minutes until our time is up. I know the different speakers have been responding to the questions and the comments on the chat. Just looking at maybe 1 or 2 questions which we can address here in plenary. One is to you, Oscar. There's a comment here around your insights on the legal and regulatory framework. There's a question on how is this being enforced, and the person also just goes on to say that data privacy is a serious concern with a growing number of digital lenders. So maybe if you can just share in about a minute how the regulatory framework is being enforced with regards to data sharing.
Thank you so much, Grace. And indeed, it's true. Data sharing now, it's really something that most jurisdictions are really keen on how this is being collected and processed and for what purposes. But in terms of how this is being done, various data protection agencies have various mechanisms. Here in Kenya, we do have enforcement mechanisms whereby data controllers, those who are collecting, be it fintech, agritech, they are required to abide by certain regulations, certain obligations within the Act, failure to which then enforcement actions can be taken against them. And the remedies therein are things to do such as the enforcement notices, basically compelling them to process data in a particular manner. We do have penalties. We've seen even small fintechs being penalized for not processing data in accordance with the law. We have issues such as compensations. If you go and probably use a smallholder farmer's data in a manner that is not compatible with the law, you could be compelled to compensate him. And then again, many other issues that various data protection agencies are putting in place here. Thank you, Grace.
Thank you. Thank you very much, Oscar. Maybe one last question, and maybe this one I'll pose to Matt, Edwin, Betty. Just a quick response on, I know Matthew's touched on it briefly, just around how these models are including or are being intentional to include already excluded groups such as women, So how do we ensure that these models don't reinforce existing biases or exclude vulnerable groups? And I'll point out here women smallholder farmers. Maybe just briefly, in less than a minute, you could respond to that based on your experience.
Yes, thank you, Grace. It's quite evident, I mean, from what we have seen on the ground, women are highly excluded. And one of the lessons learned that we draw out of the Kilombero project was how do we now move forward to ensure that there is a chance for us to provide the access to credit, even if women are not participating, being the owners of the farm, at least to support them on other macroeconomic activities through extension of credit. And hence we have now developed a gender-based scorecard. Perhaps because of time, it's not allowing us. We've developed a gender-based scorecard, which is supported from FSDT, of which we are expecting actually to be able to address some of this predicament that we saw or we learned from the previous engagement. And one of the key issue that we found actually why women are excluded is not because that women are reluctant in terms of participating within the agri ecosystem. The main point that we observed was actual data. Data itself excluding women to a greater proportion. If you look at what we observed from the Kilombero initiative was that most of the owners of the land, which happen to be the main beneficial, actually tend to be husband or male, not women's. And hence even the proceed, irrespective of whether the women were participating from the initial engagement of farm preparation up to the harvest, when it comes to the final proceed, which again determine the transactional data and where the transactional data belonging, then women are being excluded. So the moment you're excluding them from the transactional data, you're excluding them from the affordability aspect. And hence the rate of approval for any of them become minimal. So maybe I would like to hear from others, but again, that was one of the key observation from us. I mean, women are keen to participate when it comes to access to credit, but again, the data point itself, I mean, is biased, honestly, from what we've learned from Kilombero Sugar Farmers project.
Thank you, Edwin, for sharing that. Any other reflections?
Yeah, I was just going to do one very quickly, and this is a little bit of a generalization, but something I've seen across many markets across Africa and Asia, where just fundamentally it's if you think of a farm, it's usually a family business, and I've seen often, I'm not saying it's the right thing, but I've seen often where a female or the wife is doing a lot. Take dairy. The wife is looking after the cow, is doing the milking of the cow. It's the husband that takes the churn to the aggregation center and goes and collects payment. It's the guy's mobile number or the husband's name that's registered, therefore, with that aggregation center. It's the guy that receives the payment. So the female is kind of a hidden character in this process, yet a really key part of the equation, but simply their information is not being recorded. Just one final point, in Sri Lanka, I saw there was actually with tea farmers in Sri Lanka, the original tea farm had been registered in the father or the grandfather's name, and actually they didn't update the names of the farms as they went along because it was a source of pride, it was a source of sort of historical record. And again, so these women who were now running the farm were actually running the farm under their grandfather's name, and so again were kind of hidden characters, and it wasn't their number simply wasn't registered with the factory, so it's then really difficult to actually find them and reach them.
Thank you. Thanks a lot, Matt. Betty?
Yes, I think just a quick one also on my side is just for initiatives to continue to weave into women's daily programs, so that then the friction around product dissemination, what it costs, what does it mean to have a loan, does not become a longer process than it needs to be. So just to weave activities around women's meetings that are looking to disseminate solutions on credit and make it as seamless as possible also on the digital channel, so that then it's not one standalone product but perhaps comes in a bundle to make it easier for adoption and also active use. Thank you.
Thank you. Thank you. Thank you very much, Betty, and thank you to all the speakers. This has been a very insightful discussion. I'm sure we could have gone on for longer, but as Mike mentioned at the beginning, this is just the first in a series. So we are hoping to have the second webinar series in a couple of weeks. We shall be sending out communication and hoping we'll be able to get you back to continue the discussion. Again, a very heartfelt thank you to all the speakers who have been kind enough to share the various insights, to share their models, share their approaches, their challenges. We're grateful for the thoughts and for the sharing. We're also just to say thank you to all the audience, everyone who has made time for the discussion and to share your thoughts also on chat. Thank you very much for joining us today for this discussion. And again, we extend the invitation to join us for the rest of the series, which we shall be sharing the communication on. And lastly, thank you very much to UNCDF, which has been great partnering with you on this, and we hope to continue the partnership. Thanks, everyone, and have a good rest of the day.
Thanks, Grace. Thanks all. Bye now.
Thank you so much. Bye.
Thank you.